Hello out there in tax world. Good morning, good afternoon, depending on where you're joining us from. My name is Courtney Drake with Avalara. It's hard to believe, but here we are 3/4 of the way through 2024, and it's time for our Q4 outlook on 2024 tax changes. Today, I'm excited to be joined by tax experts not only from Avalara, but also from Grant Thornton, who are going to spotlight the tax trends they're seeing and the pending legislation that could impact your tax obligations over the next few months. So before we dive in, though, just wanted to go over a few friendly housekeeping reminders. So as usual, we are recording today's presentation. If you'd like to listen to it again with a colleague, you will receive a link to that recording within the next 24 hours. Keep your eyes open for that. And next, I wanted to look at the orange webinar console and a few ways that you can interact with us today. Over on the left-hand side, directly underneath the video feed, there is a Q&A box there, and you can use that box at any point over the next hour to submit questions for myself or our speakers. We will be responding to questions individually as we're able to through that Q&A box, but then we also have some extra time set aside at the end of the presentation, even if we go over the 1 hour mark for live Q&A as well. So if we have a lot of questions, we'll do our best to get through as many as we can. Can't promise we're going to hit all of them. We do get a lot of questions during these sessions, but please do plan to stick around for Q&A if you're interested in hearing from our speakers for that. And then there's also a community chat on the console that you can use to interact or network with your fellow webinar attendees. If you'd like to check that out, click on the icon that looks like text message bubbles down at the bottom of your screen, and that will pop up the attendee chat. You can also minimize it again if you find it too distracting. But go ahead and say hello there and maybe let folks know where you're from. And then also on the console, we have some related resources and links available if you're interested in learning more about the topics we'll be discussing today. All of those links will open up in a new tab and we'll be waiting for you when the webinar is over so you don't miss any of today's presentation. And that box is also where you can download your own copy of today's slides. So if you'd like to use those to follow along or save them for later, you can download them there. And then finally, down at the bottom of your console, you'll notice that there's a little smiley face. If you'd like to let us know what you think about the topics that we're covering. So give us a thumbs up, a heart, laugh, whatever it is. Sometimes these tax changes may be a little aggravating, so we might see a few angry faces, but that is available for you as well. All right, and our legal team always likes us to add a disclaimer, a friendly reminder that Avalara cannot provide legal tax advice, so everything we discuss today is for educational and informational purposes only, but as always, we do our best to answer your questions as thoroughly as we can. And then also a reminder that we are offering 1 hour of CPE credit for today's presentation. If you're looking to receive CPE credit today, please note that you will need to respond to 3 out of our 4 poll questions. The poll questions will pop up on your screen. Actually, they'll be in the same window where the slides are for a limited amount of time. So make sure that you're paying attention and are ready to answer those questions when they appear. And then in order to qualify for CPE, you must also attend today's session for at least 50 minutes. That's 50 minutes. And once you've met both of those requirements, you can download your individual certificate in the Earn Certification box on your screen that's underneath the additional resources. And then that certificate will be available to you after the webinar ends. So if you miss it, don't worry, we can still get you connected with it. All right, let's meet our 2 wonderful speakers today. So first up, we have Amanda Denniston. She is a government relations manager here at Avalara. Amanda, it's great to have you here. I think this is one of your first webinars that you've done with us, so really excited that you're able to join us.
Thanks. I'm super excited to dive in and talk to all of you. Yes, my name is Amanda, Government Relations Manager here at Avalara, and loving every minute of it. A lot of things to always talk about, a lot of things to do. So in my role, I'm actively participating in state and tax policy meetings and trying to stay informed in any potential changes. And then I'm kind of the go-between between the tax authorities and Avalara to making sure we're staying updated and updating our contact team and finding any ways to optimize between the two.
Awesome. Great to have you here, Amanda. And then next up, we have Guinevere Seward Shore. She is a principal state and local tax M&A principal or advisor there. Gwen, I also think this is one of the first times that I've had the pleasure of working with you, so it's great to have you here to talk about all things tax compliance.
Great, I'm excited to be here speaking with all of you today. Yeah, I'm a principal in our state and local tax group, focusing on technology companies, private equity, both sides of the transaction life cycle. So going through sell side or once you've made an acquisition, and just general consulting matters. I've done sales tax for the majority of my career, so excited to talk to you all about the changes and developments today.
Awesome. All right. Well, I'm going to pass it over to them shortly, but just a quick look at some of the topics that we're going to be covering today. So we're going to start off today's presentation talking about a few updates for remote sellers and recent cases that happened in Colorado and Illinois. Then we're going to talk about a Supreme Court case that they are pending picking up. We're not sure if they will yet, but that could affect use tax requirements. So we'll go over the latest there. We'll talk about economic nexus updates, retail delivery fees, and a new state that's thinking about adding them or at least researching them. And then we'll close out the session talking about the taxation of digital goods and services and some of the updates that have come out recently before we dive into Q&A. So last but not least for me, we do have our first CPE poll question. So this should be appearing in the same slide window where you're seeing the slides. But what's been the most challenging aspect of managing tax compliance for your company in 2024? And we have a few different options there. You might have to scroll down a little bit in order to press the submit button, but it is there, I promise. So a few different options: determining nexus, calculating and collecting sales tax, tracking and managing your exempt sales, remitting sales tax returns, keeping up with all of these changing tax laws and guidelines, which is all why we're here today, or international tax requirements. And you should be able to select more than one. So let us know what your top challenges have been in 2024. We'll give folks just a few more seconds to respond to this. We'll take a look at results, and then we will dive into the meat of today's presentation. All right, just a couple more seconds, get your answers in. All right, let's go ahead and look at the results. Oops, for some reason they are not showing for me. There we go. Took a second for them to pop up. So let's take a look here. Not surprisingly, 40% of you have said that keeping up with changing tax laws and guidelines is one of the top compliance challenges. Determining nexus is just a little far behind at 32%. This is, I think, what we always see. We ask this question in a few of these webinars, and I think that the results always seem to follow that trend, where we know that tax laws change all the time, and that is the hardest thing, is keeping up with them and what they mean for your nexus and determining your obligations. So thanks everyone for responding to those questions. And I am going to pass it over to Gwen to talk about remote seller obligations and some updates there.
Great, thank you so much. So we are going to start with talking about some recent changes in legislation in Illinois and I believe Colorado, but starting with Illinois, on January 1st, 2025, there will be a new method in place for sourcing sales of tangible personal property from customers in Illinois. Currently, right now, Illinois is one of, I think, only 2 states that has an origination-based sourcing rule, which means when you are looking to source sales, if you are shipping something from Illinois to, let's say, Wisconsin or New York, you would not source that sale to Wisconsin or New York. You would source it for Illinois tax purposes to Illinois, because that's where the origin of the sale and shipment occurs, which is completely different from every other state. Now, as of January 1st, Illinois is basically getting on board with all the other rules that states impose and is saying they will look at destination-based sourcing rules. This will make it a lot easier, frankly, in the administration of your sales tax when you are selling to various customers throughout the country, Illinois being one of them, especially if you have a location in Illinois. The only difference from this rule is that when you are shipping within Illinois, they will continue to impose the origination-based sourcing for Illinois state tax purposes. So local taxes. Illinois also is a state that often provides various incentives. So it's almost like tax sharing. If you make a certain amount of sales from a locality in Illinois, sometimes you get almost a kickback or a percentage of the sales tax collected. So that's why it's important for Illinois to still have that origin-based sourcing within the state. Move on here for Colorado. So this one is interesting because, it's been quite a few years since Wayfair was enacted, 2018, since it was decided by the Supreme Court. And here, in this case, Wayfair is challenging the home rule or the local sales tax nexus requirements in Colorado. So there are a few states that have home rule jurisdictions, and basically they are the localities, counties, cities, villages that have their own set of tax laws and their own filing obligations. They really have the authority to administer taxes on their own. Some of these states are Colorado, Louisiana, Alabama. Those are some of the biggest states you hear about for home rule jurisdictions, and frankly, some of the most complex to deal with when you're talking about sales tax compliance. I think one of the challenges in implementing Wayfair has been, what do you do in states that have local sales tax rules that might differ from the actual state rule? So Chicago is a good example of that, as well as New York City, and these home rule states. Slowly but surely, localities started to catch up to states in terms of Wayfair and started to impose an economic nexus threshold, often mirroring exactly what the state threshold was. This was beneficial in New York City and Chicago, because if you had nexus in the state, you suddenly had nexus in those cities, and it generated additional revenue and collection obligations. But here, what Wayfair tried to challenge is that it was unconstitutional for Colorado and the city of Lakewood, essentially, to impose economic nexus, because the Supreme Court's decision in the Wayfair ruling only extended to states and not localities. So they tried to indicate that there were certain constitutional violations, and unfortunately, the case never really went as far as it could have. It was settled and dismissed in January, and then they did not refile it in July, so it was eventually dissolved. I think from speaking to other practitioners, not really hearing a lot of other litigation in the works around the local home rule nexus standards. So I think that this is something that likely will not be challenged again in the future. And so if you have a lot of business or sales within local jurisdictions, consider it binding law for now. Continue to collect and remit those taxes. Right. I do see one question I'll just address quickly. Is nexus for home rule jurisdictions different than state nexus? And that's what we were just talking about here. Some cities have their own economic nexus threshold, whereas many just adopt the state threshold, or some don't have any different threshold at all. It's just you need a physical presence. You have to really look at the various city rules. And when you have a tax engine or research tool such as BNA, they typically have a separate listing for the city of Chicago and New York City, because those are two of the largest metropolitan areas that have different rules. When we're talking about home rule jurisdictions, you typically have to go to that city's actual website to determine whether or not they have a different rule. So if you have a lot of sales in Colorado and Louisiana, in Alabama, you should be checking that individually. Some of the cities, the home rule cities, also subscribe to a more centralized regime. Like Alabama does have a conform standard across the state. So it really, like anything with state and local taxes, it depends on the jurisdiction. think now we are going to move, since we were just talking about Wayfair and the pivotal case with the U.S. Supreme Court, I'm going to just take a moment to discuss another big case that could be heard by the U.S. Supreme Court very soon. So the Ellensing case, yet another case from South Dakota. That's, again, where Wayfair came from. And I'll say something about South Dakota. Typically, I don't think it's a state that many of us think about frequently as being on the cutting edge of different laws or different trends. But when it comes to sales tax, the South Dakota Department of Revenue and their governor is very keen to push the edge. So I was at a conference in 2016 when their law first came out about economic nexus, and they specifically said they drafted that law to get the case to the Supreme Court. They knew there would be challenges. They wanted it to be heard. They wanted the Supreme Court to kind of change the rule of the land with sales tax. So it's interesting now that there's another big case coming from South Dakota, and I wonder if behind the scenes there is some ulterior motive trying to get this heard by the Supreme Court. And this one deals with use tax, not with sales tax. So there's actually a very interesting podcast from a law firm, Evershed Sutherland, that if you are interested in learning more, you should listen to, because it really goes through this in great detail, and especially if you are somebody who deals with contractors or contractor rules a lot. If you think about it this way, I buy a hammer and I'm going to use it in South Dakota for the whole year, but I bought my hammer here in Maryland. I'm going to pay use tax on the same price, whether or not I use it for the year or not. But let's say Courtney buys the same hammer and uses it for only one day. She is going to pay use tax on the same purchase price. There's no concept right now of apportionment for sales and use tax purposes, except if you're using a multi-state certificate to apportion or allocate the use of software. But how does that seem fair, right? She's using the hammer for one day, I'm using it for the whole year, but we're paying the same tax to South Dakota. And that's really at the crux of this case, and why certain attorneys and practitioners are writing petitions and asking the court to hear the case. Here, the taxpayer Ellensing Drainage, basically with tax and with penalties and interest, had a $75,000 bill received from South Dakota because they had purchased equipment that was going to be used sporadically in the state throughout the year. It was coming in, going out, like many contractors use their equipment to perform jobs within a state. They argued that they should be able to apportion a percentage of the purchase price of this equipment and pay use tax to South Dakota based on the number of days that the equipment would be used in the state. And then they would pay tax, either sales tax on the purchase in their home state or use tax in other states, so that they were sharing the burden across states. Otherwise, the argument is there could be double taxation. Because think about it this way. I'm paying, again, tax to South Dakota for the whole year, but then I bring it into California, and suddenly California wants some tax as well, and they have a higher tax rate than South Dakota. So you could continue to be taxed on the same piece of equipment again and again if subjected to an audit, or if you're very by the books in your use tax reporting. And it gets a little ridiculous in terms of the double taxation element here. So this could be a very important case for construction contractors, anybody who is using equipment, bringing it in and out of a state. And the Supreme Court should meet on September 30th to actually hear some of these arguments and rules and decide whether they're going to take the case or not. Sorry, just a little background. The interesting thing about the Supreme Court is that many of the justices aren't as knowledgeable about tax. So they often will rely on their clerks to recommend certain cases that they should hear. And hopefully there's a clerk who has some tax background, because that's typically how we get these through. But I've heard as well that there is another case similar to this in Massachusetts. So if enough cases start coming up, we really could see this coming to fruition in the Supreme Court, and hopefully have a new rule where use tax can be apportioned. So interesting for construction contractors, but probably another layer of burden for your tax reporting compliance. I see questions about the podcast.
Right, thanks, Gwen.
If you search for Ellenson and Evershed Sutherland, it'll come up as part of their Salt Shaker website. Let's see. And I hear something. Yes, unfortunately, I'm gonna go on mute because I have some vacuuming in the background, but it's my turn to turn it over. I'm so sorry about that.
No worries. Thanks, Gwen. So we have our next CPE question up on the slide here. So if your business has, your business had to make changes to your finance team processes to account for tax changes that have gone into effect, it doesn't have to necessarily be in 2024, but just in general, let us know if you've had to make changes to some of these, the way that your business handles its tax management processes. So again, we'll leave this up. I am not going to subject your ears to my version of the Jeopardy music, so we'll just wait for a second while we get responses that come in. All right, just a couple more seconds. All right, let's take a look at the results really quickly. So 43% have said that tax changes have had an effect on their tax or their finance team processes. 42% also said no, but I think that's still a pretty big chunk. Where if you have tax law changes that go into effect that affect your business, you obviously have to find some way to comply with them. So thanks everyone for responding to that poll question. That was our second one. We do have two more, so keep your eyes and ears open for that one. And then I am going to transition it over to Amanda, who's going to talk to us about some of the updates in the economic nexus world.
Great, thanks. I'm seeing a couple questions in the chat, so I will just take a step back. I was curious too. So first, what nexus is? I think a couple of people asked is similar to what other people are asking. Is when do you have to pay tax in another state? So if you trigger nexus in another state, that's the term they use, then you have to pay sales tax. And so we're going to talk more about what those triggers are. So an example, I am in the wonderful state of Maine. If I make mittens, I hand make mittens, and I sell those mittens online at a certain point in time, if I sell X amount of mittens out of state to New York or California or Alaska, I have to pay sales tax for that state. Does that make sense? So this is part of that Wayfair decision, which is another term everyone uses all the time, where we came up with this new rule of you do owe sales tax in the state if you are selling a decent amount, right, into. And so what that was, or what was determined by the states determine what that is. Many follow a lot of the same rules, like the streamlined sales tax kind of came up with a guidance, and a lot of companies followed kind of their guidance, which was somewhere around $100,000 to $200,000 of mittens or 200 transactions. And my mittens example is going to roll right through this mittens example. In the past 5 years, I don't know if you missed it, but it's been a little wild in the world and how we do things and how we get our things and how we're spending our money. And so states have to adjust to this kind of new and ever evolving world. And states are a little bit slower than perhaps the free market and how we all do business. especially with the pandemic, we get way more things delivered. We order more things online. And so how are states going to kind of make up for that shift in how we're buying our things and how we're getting our things? So 5 years later, here's a couple of states that are making those changes because of again, how different businesses. So Indiana, Wyoming, already this year got rid of that 200 transaction trigger for Nexus. So again, in my mittens example, selling 200 pairs of mittens to Indiana actually isn't a lot, right? It's not a lot, and it's probably not a huge amount of money, and it creates a big burden on the mitten maker or the business to keep track of Nexus in all those states. Because what if I sell 200 in Indiana and then 210 to Wyoming? That's a lot of work for the small business to try and keep up with. They are keeping the monetary trigger because that is different, right? Even if you sell one airplane, you're gonna trigger Nexus in that state, but that's a little bit different than the small business who is selling 200 pairs of mittens or socks or whatever. So the next one that we have heard about that's coming is Alaska. So Alaska is one of the few states that doesn't have a state level sales tax, but they do have taxes in different local jurisdictions and in cities and boroughs. So they can have their own sales tax, and those kind of vary between, up to I think 7.5%, depending on the jurisdiction. So if I sell those 200 mittens to Alaska, I could have, and I currently would, trigger Nexus in Alaska, but starting January 1st, they're going to remove that, and it's just going to be the $100,000, which is a lot more mittens. I guess it depends on the cost of the mittens. New Jersey is also talking about getting rid of the 200 transaction threshold, and then the Streamlined Sales Tax Organization is actually recommending that all of the SST states drop this threshold as they try to adjust to kind of this new market we're all existing in. I think someone else asked this in a question too. So looking at the different thresholds by state, so you can see some are the amount of money, some have this $100,000 or 200. I think New York is the $500,000 and 100 transactions. And it's up to the businesses to try and keep track of all of that. So to getting rid of the 200 transactions, hopefully is going to simplify this so it's not as complex for the businesses. We're trying to align with kind of just modern commerce of how, again, we buy and receive our things. And it hopefully will cut down on a lot of that administrative work for the businesses who, the 200 items is just kind of not worth everyone's time and energy to keep up with. So hopefully that this will focus on more of like the significant economic activity and cause less burden on the smaller businesses. And then I think
before we move on, I did see a really good question in the chat. Does Nexus come into play when you sell through a marketplace? And I want to touch on this because in my line of work, I see this all the time. You are selling FBA, so fulfilled by Amazon. You sell through eBay. That is an online digital marketplace. And technically, with marketplace facilitator statutes, those online marketplaces are responsible for collecting and remitting sales tax on your behalf. However, when you are looking at Nexus, you have to consider every single sales channel. So what if you sell through your own website and through Amazon? You're not just looking at the sales through your website in order to determine whether or not you have established Nexus. You have to look at your worldwide or your nationwide sales, so those Amazon sales as well. You see so many companies who are not properly determining their own Nexus and filing obligations because they totally ignore a sales channel. So that's a great question. Definitely have to consider that. And I see a lot of questions as well about Nexus for SaaS software, states, et cetera. We don't have a map for that. It's also a very fact-specific determination. You can see, I think Avalara has a great white paper about which states typically tax as, but there are often various facts and circumstances that you need in order to determine that. So I would definitely consult your tax provider when making that determination about whether or not your SaaS sales establish nexus. But let's move on to retail delivery fee updates. This will be a little bit more brief here. Okay. So 2 states who have recently enacted some changes with their retail delivery fees. Colorado, again, typically tends to be more of the cutting edge of some of these sales tax provisions, and they've had a retail delivery fee for quite a few years, actually. And let me give some background on these retail delivery fees. So they are a fee that is typically imposed on an emergency or specialty delivery service such as DoorDash, Uber Eats, or Amazon delivery. But they are not typically imposed on common carriers like UPS or FedEx. And what you are seeing here is the state's goal and attempt to impose tax on a new revenue stream for them as they see it. So similar to how states started having those Amazon laws like New York and then Wayfair type provisions, they are reacting to the change in our economy where, you know, we want something next day delivery, prime delivery. And there are greater trucks on the road. So they're using this as a means to justify the fact that they need more in their transportation fund to maintain the roads. And these trucks from Amazon, for example, are making use of the state's resources and therefore should pay this additional fee. But also many of these states do not have enough money in their transportation funds to maintain bridges, to maintain roads. And that is because there are a greater amount of electronic and more eco-friendly vehicles, which is reducing the amount of fuel tax that is being imposed on these larger transportation companies or vehicles. So they are looking for ways to kind of replace that revenue, you know, less money coming from gas taxes, fuel taxes. So we need to supplement it somehow. And in terms of the fuel taxes, one of the arguments against these retail delivery fees is that one, it's not fair and it could really be unjust in terms of interstate commerce because you're imposing this tax on one subset of companies, but not the other, like the common carriers. But also it could subject these common carriers to double taxation because they are also subject to the motor fuel tax and then this retail delivery fee as well in the same transaction. Plus, the biggest argument against it is that it does not take into consideration IFTA, which is the Internet Freedom Tax Act. And it says that states cannot impose tax unfairly on services or products that would be non-taxable if it was provided over the phone or over the catalog. So they can't tax it just because it's provided over the internet. So that's something here that really hasn't been taken into consideration. And I think as more states have these types of delivery fees, you might see more challenges. So Colorado basically change here is that they are going to increase their fee from 28 cents to 29 cents. It already went into effect this past July. Also in July, Minnesota started to impose their delivery fee as well. And you'll see that in both states, there is an exemption for certain small businesses, 500,000 in Colorado and 100,000 in Minnesota. So they are trying to take that into consideration. But that also provides complexities because you have to figure out when are you going to exceed that threshold. Plus, in some of these states that have the delivery fee, certain transactions might be exempt. So you have to also analyze the taxability. So I think you'll see a lot more coming in terms of these delivery fees and challenges to those in the near future. Washington as well has kind of published a report and is considering their delivery fee. And I think if Washington were to enact something, definitely a lot more challenges just given the fact that that's Amazon's headquarters. Oh, now we have a polling question. Go ahead.
Yep. Sorry, I just saw that. So this is our third out of four CPE poll questions. So have retail delivery fees impacted your business in 2024? I know on these webinars, a lot of people have been confused around what retail delivery fees are, when they apply. So we're interested in hearing from you on if it's impacted your business in 2024. So again, we'll give folks a few seconds to respond to this. We're getting lots and lots of great questions in here. I do see a lot of questions on economic nexus, and I did want to call out in the additional resources section, there is a nexus guide, and I'll put a link in the attendee chat as well, but that offers a state-by-state look at what each state, what their thresholds are, what's included in their nexus threshold if they're only looking at taxable sales versus exempt sales. So again, I'll put that in the attendee chat, but that can be a great resource to help you determine what's going on with Nexus, and it's something that we keep updated as well. All right, let's take a look real quick at our poll results. So this is interesting. About 30% of you have said that the retail delivery fees are affecting your business. 61% have said no. So we'll be interested to see how this changes if and when more states adopt this. So thanks again, everyone, for responding to that poll question. That was our third. We will have one more. But Gwen, I'm going to pass it back over to you to talk about digital products and services. And I've seen a ton of questions around this, so this one should be interesting.
Yeah, so going through, so taxation of digital goods and services tends to be a really great area to discuss because there's so much evolution and change. So, new technology coming out, different ways the states are reacting to it. So wanted to go through a few things that I found interesting in the last quarter. I work a lot with technology companies, so we're constantly monitoring and talking about these changes in taxability. New York is always an interesting state. They issue a lot of guidance and they issue a lot of rulings throughout the quarter. So it's a great resource for determining whether your fact pattern might be taxable or not. Obviously, it might not be exactly the same, but it's a great state for that. Recently, they issued two rulings that I found helpful because it dealt with whether the provision of software as a service bundled with a non-taxable service could be taxable or not. I think there are a lot of companies that will provide a non-taxable service like processing or payment processing or some sort of document analysis, and then also provide access to a SaaS platform in order to provide or help that service along, and think that because they don't charge for the software platform, there is no sales tax due in New York or other states that tax SaaS, because their argument is the true object or the primary function of the contract is providing the processing service, the payment processing service. Here, however, in these two rulings, New York has very clearly said they are not going to look to what the primary function of the overall contract is when there is a bundled transaction of software as a service and a non-taxable service. Instead, they are going to deem that to be taxable. And part of the reason is because New York does not have a de minimis threshold for bundled transactions. A lot of states say that if less than 10% of the overall cost or transaction is the taxable element, then it's not taxable. New York doesn't have that threshold. They say that any small amount will render the transaction to be taxable. So the two rulings, one was matter of Beeline, and essentially a taxpayer charged fees for their vendor management system. And that system helped to match customers, which were various companies who needed temporary workers. Those companies were matched with the supplier of temporary labor and then purchased temporary labor. So access to a platform and non-taxable labor services in New York, that was deemed to be taxable, even though the true element or the primary function of the transaction was to obtain or match these companies up to make a contract for temporary labor. And then in matter of facility source, similar situation, facility management software The non-taxable service was the main point of getting access to the software, but was also deemed to be taxable. So definitely something to consider in terms of your contracts, in terms of what you're selling into New York. It's a tricky state for sure, but the onus is always going to be on the taxpayer to prove otherwise in New York, because it is very, very stringent in terms of the way it classifies these transactions. And then in Texas, there is a similar push to look at or look past the essence of the transaction. So every state has a different name for these bundled transaction tests. New York, it's primary function. Some it's true object. In Texas, it's the essence of the transaction. And that was determined or promulgated by court law in Texas. So various cases kind of established that case law, and it has been the way to determine whether a certain transaction is taxable data processing in Texas for quite a few years. However, in the past 5 years or so, auditors have been applying a completely different rule. And now the department or the comptroller is proposing to amend their rule 3.330, to apply it to rulings and actually, make it more binding. And the changes basically say that Texas is going to consider any transaction that has an element of data processing to be taxable, and will put the burden on the taxpayer to prove that it is not taxable, even if data processing could be a tiny element. The changes to this rule also expressly classify any electronic marketplace provider as performing taxable data processing. But more concerning is the fact that it defines as taxable data processing services that include search engine optimization, social media marketing, so like Instagram, and lead generation, but doesn't define these terms at all. So it's very broad and very all-encompassing. And a lot of taxpayers are going to suddenly find themselves with a tax obligation or not with enough clarification to determine how they should be remitting taxes. This is another one that kind of ignores IFTA as well, because what if these different services were provided not over the internet? They wouldn't be taxable data processing. So could see some challenges to IFTA here as well. On the Florida announcement, this is kind of shifting away from sales tax, but it could have some implications. So Florida Governor Getz introduced in June a bill that would allow Florida residents to pay their federal taxes, so IRS, pay those taxes using Bitcoin. What's interesting is that there is already a law in Colorado that authorizes the payment of any state income tax using cryptocurrency. I think in Colorado, that's the case because of the industry that is prevalent in Colorado and the fact that a lot of it is tied up in crypto, and federal reserves and banks aren't able to hold those types of funds from certain activity. But Florida could be very interesting if that paves the way, because they also have a communication sales tax, and there has been some discussion that payments using digital currency could get caught up in that communication sales tax as well. So this could be interesting on the sales tax front if it passes. And then in Michigan, NFTs, this is an example of a newer concept. 10, 15 years ago, software as a service was the hot topic and how that was going to be taxed. Now it's NFTs and AI. And for those who don't know, an NFT is a digital asset that can be held on the blockchain. So it's not really fungible. And it links ownership to something unique. So it could be a piece of digital art. It could be a piece of real tangible art. It could be music, could be, it's kind of like a modern patent office in a way to record ownership. But it's held on the blockchain. Many think it's more secure. It's it's digital. So that NFTs are, in most states, I would consider them to be a digital good. There are about 30 states that tax digital goods. There are only 3 states currently that have specific guidance on NFTs, and that's Pennsylvania, Wisconsin, and Minnesota, all of which say that NFTs are subject to sales tax. The Michigan law is interesting because it's twofold. One, it says typically an NFT will not be subject to sales tax if it represents a digital ownership of a digital item. But if it represents ownership in an interest that is tangible, then it will be taxable. And so think, what could be a tangible ownership interest? Something really common is buying an NFT for whiskey futures. Whiskey, there's been a shortage of like fancy whiskey. That liquor bottle is tangible. So that likely would be subject to sales tax once you are transferred ownership in that future whiskey. So I think you'll see more states providing guidance on NFTs as it becomes more mainstream. Michigan is just one of the first. I do think it's the mix of states, excluding Pennsylvania, Wisconsin, Minnesota, and Michigan. It's kind of strange that those are the ones that have some guidance before, like New York and Texas, for example. In Texas, however, I would probably expect that it is subject to sales tax, given how broad their processing statute is. And then the last update here, Vermont, they, effective July 1st, 2024, now impose tax on software as a service. Previously, they did not. So as we were talking earlier, Vermont was one of the later states to enact Wayfair as well. So if their statute for Wayfair looks at whether only tangible items are subject to tax or includes tangible goods in the calculation of nexus, the change in tax classification here for SaaS, if you're a SaaS provider, could change your nexus determination as well. So that's definitely a lot of planning considerations here around these changes. I see a question about Texas. Is the data processing 80% still going to be imposed? So Texas will still, the proposed change in the rule does not take away that 20% exemption, which is applicable to most items that are considered data processing. Let's see if there's any other states here. Kind of business that sells bundled products with different tax codes apply tax on a basis that states will allow. I think that's more of an Avalara specific question. And I mean, from my perspective, when I've helped do mapping and implementations with Avalara, typically there needs to be some change in maybe the invoicing or SKUs that you're presenting so that they can be mapped properly. If like in New York, there is a different rule than what the Avalara matrix provides, you can do a custom rule for New York so that in other states where that bundle transaction would not be taxable, you're still getting the right result. But in New York, it's a custom mapping. So that's why we say we work very closely at my firm with Avalara and partner to do a lot of these things because there's so many elements with the implementation of technology and the tax considerations as well. All right, and Amanda, I think this is you talking about the streamlined sales tax?
Yeah, I think I saw there was also a few questions, and again, I'll just be the step back lady. Of someone asked if we could like define what a digital good is, and that's actually the challenge is that there aren't uniform definitions, and it changes based on the state, or like you said, if it's bundled or what it is. So that is kind of what states and jurisdictions are reacting to. So there actually isn't a simple answer to that one. And as jurisdictions try and figure this out, we're going to kind of see more of this activity like Gwen just went through, of just people kind of trying to adapt to what is happening out in the new real world. There's also been some increased audit activity. Post, again, pandemic was just, everyone was holding on. So post pandemic, we're hearing of some, increased audit activity, and they have a few more tools in their tool belt, right? Too, there's more information available online, and they can use, jurisdictions can use things like AI themselves to do some research or, find maybe those next places that they're going to choose to audit. Because this is complicated and changing, some of the larger entities that we look to are trying to make these definitions. So Streamlined Sales Tax Organization that we already talked about and the Multi-State Tax Commission are both actively working on ways to make these sales tax systems better and create content. So they're trying to clarify those definitions. They have SST, I know, has a regular in-person meeting, and MTC has a digital work group that meets via Zoom or WebEx, I guess, technically, which I sit in on, where they are just kind of going through all of these different possibilities and how would this go, how would they, classify this and trying to clarify those definitions for us. And in those, they're kind of, proposing some model legislation of what this could look like if you use these definitions. And also, as Gwen said, what are those sourcing rules? How are you mapping what you have to an existing, definition of what one of those digital goods is? And I just think, again, that's just going to be a constant work in progress as businesses develop and find new ways to do business.
All right. Well, thank you, everyone. So this is our last poll question. We're going to leave this up for a few minutes, but if you would like a follow-up from an Avalara specialist, go ahead and select yes if you're interested in learning more about tax automation or how it can help your business. So like I said, we'll leave that up. We have had over 100 questions in the Q&A box, plus we have the attendee chat. So we're going to do our best to start going through some of these questions. Gwen and Amanda did a good job of being able to look at those while they were speaking, which is not one of my superpowers, so I'm impressed by that. But we'll dive into these, and I'm going to do my best to go back and forth between the Q&A and the attendee chat. If I miss something in the attendee chat, go ahead and put it in the Q&A. And we'll just start getting after these. Let me do one thing real quick. All right. Let's see. So for retail delivery fees, maybe we can start there. I think there was a little bit confusion around which carriers it applies to. So this specific question says, did you say that it only applies to specialty characters like Uber and Amazon, and that they do not apply to major carriers like FedEx and other carriers like that? Can you confirm if that's correct or not? Gwen, that might be a question.
It depends on the state. Often it depends on the state. Often it depends on how it's defined, how the transactions are done. Initially, it tends to fall mostly on the Amazon and specialty delivery companies, just for the way it's structured. But it can also be any delivery into the state using a common carrier as well.
Got it. Okay. And then another question on the retail delivery fees, this time from Minnesota. Does the $1 million limit apply if we sell directly into Minnesota? I think so, but wanted to clarify that the $100,000 limit is only applying if selling via a marketplace. Can you clarify that?
It's for deliveries into Minnesota. It doesn't just have to come from a marketplace, but because overwhelmingly a lot of these deliveries are occurring because of an order over a marketplace, that's why it tends to focus on marketplace providers. But it's any delivery in the state. It doesn't have to be placed through a marketplace.
Got it. Okay. And then we had a question come in around Minnesota on clothing delivery. So they were specifically asking, does it apply to deliveries made by common carrier? So I think the The answer is yes.
I was just looking. I don't know. It's, yeah, sales tax subject to sales. It does seem to apply to clothing, but there are certain exemptions, like certain baby products might be exempt, certain things that could qualify as a medical item. So again, that's why it's really important to read all the different definitions and descriptions, because typically it is including clothing, but there could be some exemptions within that.
Yeah.
I think that is part of the, when we're going to probably see more of the backlash and other, people bringing these to court, is that gets really complicated. If you have a shopping cart with mixed things, right? You have a shirt, which is taxable, but then you have, something that's tax exempt, that's a lot on the business, or, businesses also aren't just like taking cash and putting it in the safe anymore. They're using some type of point of sale system or accounting software. And so you've now added a new complexity of keeping track of what is, what isn't, what's retail, what's sales tax. What if someone returns the item? It's just, it adds this, makes it very challenging on businesses to keep up with that. So I think people are going to start making noise about it.
I mean, essentially you're doing taxability twice, right? It's the sales tax on the transaction, and then you have to figure out is it subject to the delivery fee. So you're right, it's becoming way more complex.
Yeah.
And I believe in some, those are also filed separately, right? Your sales tax is filed over here, and then your retail or your delivery is filed someplace else. That's also, now you've added a new filing process.
In Colorado specifically, there's a different form.
Yeah. All right, let's switch gears a little bit to economic nexus. We also had a ton of questions that came in around that. This person was back to the airplane example. So once you establish economic nexus, sorry, I just lost the question. Does the seller owe sales tax on that one sale that exceeds the nexus threshold, or is it on any future sales once they've met the threshold?
When you got that, do you know that one?
Yeah, no, that's fine. So, I mean,
don't want to be wrong.
It depends. Technically, you look at the state and what the measurement period is, because some states, they look back. It's a historic measurement period. So you would have already known that you've exceeded it and it's a few months past. What I always say is, if you've exceeded the threshold and you aren't making any other sales into that state, technically you have a filing obligation as soon as that threshold on that sale is exceeded. But it is also a business decision about whether or not you're going to file, because you know your business best, and maybe it's a one-time sale. Typically, though, when people are selling, or companies are selling into states and they trigger that nexus threshold early in the year or in the period, they're going to keep making sales. So it's just easier to start collecting from your customers rather than potentially have exposure or a liability previously. And I will say there's also a grace period in a lot of states, right? Like once you've triggered that nexus threshold, many states will say you have 30 or 60 days to get compliant. Now, some of them actually have that written in their statutes, some that's more informal guidance. So that's why it's always, if you know you're going to be making a lot of sales and you start hitting or getting close to nexus thresholds, there's no risk, especially if you already have Avalara implemented, in starting to collect from your customers, because the tax is on your customers. You're just collecting and remitting.
Yeah. And then there were a few clarifying questions. So when we talked a little bit about marketplaces, are there any states where they are excluded, where marketplace sales are excluded from the economic nexus thresholds, or are most states including them?
So when you are selling something over a marketplace such as Amazon, typically it's going to be a tangible good, and tangible goods are almost always included in the definition of a sale that qualifies for nexus, economic nexus. The only exception would be if it's a state that says it does not include non-taxable sales. So it's something that in that state has an exemption, but it's I haven't seen a lot of marketplace sales that would qualify for that. And again, if you're selling over a marketplace, unless you are selling just one very niche item that is exempt, it's likely that you've established nexus.
Yeah,
I think
okay.
I'll add on to I feel like the answer to all of these questions is it depends. So it depends on what you're selling and who you're using. So like in the example of like food and restaurants, if you're using like an Uber Eats, it actually is different by state. So you have to like know which states is Uber Eats collecting the sales tax and which ones are you. And I've run into too many restaurants where you're double collecting this or double paying the sales tax because they weren't aware Uber Eats was doing the sales tax and they also were paying the sales tax. So back to the it depends answer.
Always. Yep. Let's see. So we are right at 9 o'clock hour. So I know some folks are going to have to jump. Like I mentioned at the beginning, we're going to stay on for just a couple minutes longer and try to get through the majority of, well, I don't even know if it's going to be the majority, a few more of these questions because we have had a lot of great ones. So again, staying on the economic nexus theme, this one is asking specifically about Alaska, but in general, so say that your business met the 200 transaction threshold in Alaska, they're removing that. Can you stop filing if $100,000 is the new threshold and you have not met that, if you have already been collecting sales tax?
I mean, here's where you weigh the benefit and the cost, right? Like it probably takes more time and it's more of a headache to stop collecting and filing and deregister. And then in a few months, you might just have to register again. So typically our recommendation and what we see is the practice among many different industries is you continue to file and collect. It just doesn't really have much of a benefit, honestly.
Yeah.
And I mean, you need to know your business and your business, projections in the future. So it might be now, but like what Gwen's saying is it worth it to stop and then have to start again next year?
Yeah. Okay, let's see. Switching gears a little bit, this question is around SaaS compliance. So they're specifically asking, is SaaS sales tax compliance based on users in the state or the location of where the software contract was executed?
Great question. And to Amanda's point, it really depends on the state because certain states have specific sourcing rules for cloud-based or computer services. But typically what you want to do is look to where the user is located. That is ideal in what most states want. However, I encounter a lot of companies who say they don't have access to that data. And I think realistically, if you're in technology, you're able to get down to the IP and the user address. It's just that maybe they're not tracking easily where users or licenses are located. So states will accept that you are using the billing or contract location. The problem there is if you get audited by a state that imposes tax on your customers like Texas and you're not allocating any of that sale to Texas, they're gonna want all of it, right? So it makes an audit a little trickier. What we typically recommend is our customers who are technology companies try to understand or put in their contracts where user location might be, so they have that in case there is an audit to fall back on. The other issue is when you are allocating only to one state and not looking at the user location, maybe you're paying too much tax because you're not taking advantage of the fact you have users in non-taxable states. So short answer is, to recap, should be user location, but states will accept billing or contract location as well.
Okay, I saw a question, what is the Colorado form for the delivery fee? So I think when you mentioned that it is a separate form that you have to submit.
Yeah, it's like form 338. I just was looking at it.
And this person also asked, does Avalara automatically include this additional form when filing Colorado returns? So I know the answer to that is yes. I'm not going to be able to provide additional information on the form though.
It's form 1786. I was wrong. So it's a completely different form you can file online or by paper.
Got it. Okay. All right. Are there any other questions from either one of you that stood out that you would want to address? Otherwise, we are still getting questions in, but I think some of them are going a little bit more beyond what we're able to answer in terms of not providing legal tax advice. So once it gets into specific digital goods and situations in tax, we can't go that nitty-gritty, unfortunately. But wanted to pass it back over to you and see if there was anything that you would like to address.
I see one here that I do just want to. The question is, does the Illinois change affect SAS or home rule that Chicago imposes? So, I mean, Illinois does not impose sales tax on SAS. They only impose tax on digitally or electronically downloaded software, canned software, and they have the 5-prong test for custom software. Chicago, however, does impose tax on SAS. So this is a great example of, Chicago has an economic nexus rule. Illinois has an economic nexus rule. Depending on what their guidance is, you might get one answer in Chicago and one different answer in Illinois, because if Chicago were to exempt, if Illinois were to exempt SAS, but Chicago includes it, it could come out to a different result. But I think that they are both aligned, and it doesn't come out to a different result, is my recollection from when I recently looked at this. So it shouldn't have too much impact.
Okay.
I see one asking if we've seen cases for people double paying sales tax, and absolutely. I'd say more often than you would think. I mean, I specifically worked with one when it was like $90,000 double paid in sales tax. So, but working with the state, it's time consuming, and they needed help, but definitely can do that.
Yeah. All right. Well, I think that we are almost 10 minutes afterwards, so I think we're going to go ahead and wrap up. I know that we obviously were not able to get to all of these questions. I think that we are well past 125 now. So thank you, everyone, for being so engaged. We do have saved copies of your responses and are going to be passing those along to our Avalara representatives to take a look at and reach out to you, hopefully with some additional information. So please stay tuned for that and look to hear from someone. I did just want to remind everyone, let me move to the next slide here. Like I mentioned at the beginning, we did offer 1 hour of CPE credit. So if you did qualify for that, you should be able to download your certificate in that Earn certification box. And then there will also be a link to your certificate in the follow-up email that contains the recording as well. So if you don't get a chance to save it today, no worries. You'll be able to access it in that email. Many people did ask at the very end if we are sharing the recording, and yes, we have recorded this. We will share the link to the recording within the next 24 hours, so keep your eyes and ears open for that. And I also wanted to do a shameless promotion for Avalara Crush, which is our big customer event. This year, it's happening November 11th through 14th. It's going to be in Austin, so we are bringing our big Crush event back in person. If you enjoyed today's presentation, learning about the latest tax changes and what's going on, we are going to have sessions similar to this at Crush, as well as many others. So if you're interested in that, there is a link to, it's avalaracrush.com. There is a link to that in the additional resources section if you'd like to learn more. But go ahead and get registered soon, because our hotels are booking up quickly and want to make sure that you get a good hotel space for that. So thank you again to Amanda and Gwen. Really appreciate you being here and the research and time that you spent putting into this and answering all of these questions. So appreciate your expertise. Thank you for joining us.
Thank you. It's fun.
Yeah.
Thanks so much for having us.
Yeah, I'm glad you think so. There might be others in your future. All right. Well, thank you to all of our attendees as well. Hopefully you found this information valuable, and we will see you for one of our future webinars. Speaking of future webinars, we actually do have a webinar coming up on the taxation of the SaaS and software and digital products. There were a lot of questions that came in about that. There is also a link in the additional resources section to our general webinars page. If you click on that, you will find the registration page for that webinar that's coming up. So if you are in that space, are selling software, digital goods, definitely recommend that you register for that webinar, and hopefully we can answer more of your questions there. So we'll see you for one of our future webinars. Thank you, everyone. Have a great day.